Who would have thought that an oil price contract could negative, but that's in fact what happened over the last few weeks. The backdrop here, though, is as this chart makes clear, is we are living through an unprecedented decline in the demand for oil. Through the first half of this year, we're now expecting demand to be down in the order of 15 million barrels a day. Now, for some sort of context, during the worst period of the GFC, we had a drawdown in demand of just under 3 million barrels a day. So what's happening at present is really unprecedented in modern times, and the thing that preceded that, which ultimately led to this negative situation with the WTI contract, was the breakdown in the OPEC alliance, whereby when that alliance broke down back in March, there was an agreement to increase production just as the worst of the COVID crisis was hitting, and that resulted in storage filling up very rapidly. And so, because the contract for oil is physically settled, as the May contract drew towards expiry, with no place to store oil, you're actually getting paid to take oil if you could find somewhere to store it. So that led to that unusual situation of a negative futures price. Now, the price of the physical commodity is not negative. You'd be glad to know, and you can see the futures curve on the chart, which goes out to the sort of midterm for both Brent for futures, is still relatively normal in terms of price and slope. Certainly an unprecedented sort of backdrop that we have today. But thinking more broadly around demand, it's worth just considering where demand comes from today and where we think it is likely to come from in the future. You can see the pie chart there on the slide, which breaks down oil demand by application, road gasoline being the largest. That's passenger cars for the most part. Air travel, which is obviously in the headlines, is a relatively small part of the oil space. But from a demand perspective, just if you draw your eye to the lower bar chart, you can see that the consumption of oil on a per capita basis in non-OECD countries is still very low relative to places like the US and South Korea. US today, for example, consumes around 13 barrels of oil per capita per year, and that number in China is about 3.5, and in India is only about 1.5. So, we see demand very much underpinned by developments in the non-OECD countries, and the long-term track record of oil demand has been growth of about 1.5%, outside of these sort of macro shocks, one of which we're living through today. So that's probably how we see demand play out. We note there certainly will be headwinds, and they relate to decarbonisation programs that are underway in various parts of the world. But for the most part, those, even if they come to fruition, will result in a relatively modest decline in the demand for oil. To give you a number or some numbers around that, electric vehicles, perhaps the most bullish forecast we can find of the electric vehicle fleet at 30% of total units by 2030. If that were to play out, that would result in a roughly 2% reduction in aggregate demand for oil today. But that will be spread out over 10 years. So the world has always tried to adapt to low energy solutions, and electric vehicles are another iteration of that. So we don't see a major dislocation in the demand side of the equation for energy.
That's great, Graham. And what stands out to me is just, the fact that, that we associate oil with passenger vehicles, because that's what we fill up with each day. But it's really just a quarter of the market. And secondly, just the fact that emerging markets are really the source of the majority of demand, and certainly most of the demand growth. So turning to the supply side, take us through what's going on this chart, and what the implications for supply are, given the lower price environment we're at least at the short end of the curve.
Sure. Well, supply is where we think it gets interesting. You can see that the chart there is what US production growth. The bar charts are the year-on-year change in production, which peaked in the middle of 2018. Over the last decade, the world has grown production by about 12 million barrels a day. The important point to note of that figure, however, is that 3/4 of that growth has actually come from the US shale industry. And us, along with many others, have had concerns around the economics of that production for some time. In the first phase, capital markets were willing to sponsor that. But in recent years, they've become much stricter around what shale needs to achieve in order to attract investment dollars. And the truth is that over the period from 2010 to 2019, the industry has roughly spent 125% of every dollar that they've taken out of the ground in terms of cash flow they've had to put in to generate that output. You do that for a little while if the capital markets will sponsor it, but it's not a long-term sustainable situation. So you see in the chart that production growth out of the US was already coming down as we headed into this crisis, and clearly the impact of COVID-19 has accelerated that decline, and we're expecting that capex in the US shale patch this year will be down in the order of 50%. The chart that's before you now gives you a picture of the recent history, so you can see that production, capex, I should say, peaked in 2014, coincident with the oil price, has stepped down from those levels, and we're expecting another 30% reduction based on what we've heard from companies as they reported their Q1 results, another 30% cut capex in 2020. So look, that sets up the next 5 years. You can see the bottom here for base level production as well as newly sanctioned projects. And the picture is one of supply continuing to decline. And the forces at play from capital markets that were already evident have now been accelerated by COVID. And so our expectations are that over the next 5 years, you'll have a very limited supply picture in oil. And of course, that sets up the commodity to be quite interesting as economies normalize and demand recovers to a normal state.
So look, in terms of investing in the sector, at Antipodes, we are ultimately looking to invest in companies that are resilient, offer us multiple ways of winning. Now, probably back when oil was $100, many investors would have, found, plentiful opportunities in the sector. Now, there's a lot of skepticism around whether you can make any money in the sector. Take us through why you think Equinor qualifies as a resilient investment?
Sure. Yeah. So I guess the first point to make is, in a fragmented commodity industry like oil, what are the things you're looking for? Well, frankly, there's two things you're looking for. What is the position of that company's? What is that company's position on the cost curve? And secondly, what is the track record of capital allocation? And those two things really go a long way towards making a successful operator in this sector. Equinor, Norway's largest oil company, is, we think, an example of that. They have a track record of being way down the cost curve with very smart capital allocation decisions over a long period of time. That gives us exposure to upside to oil price if our supply demand scenario plays out. But in addition to that, the company have, over the last number of years, have been developing a renewables portfolio that we think is underappreciated by market. This is an offshore wind development that allows the company to supply very low carbon emission energy back into the system. And on a standalone basis, these assets have become very valuable in the market in recent years. And when we benchmark Equinor's wind assets to standalone entities, we think it could be worth as much as $15 billion or 25% of the enterprise value. So that makes it interesting on a number of angles. And you can see the chart, the lower of the two charts there, shows Equinor's greenhouse gas emissions per dollar of revenue is one of the lowest in the industry. And of course, as you mentioned, Jacob, the valuations of these stocks in recent times have become quite cheap on average, and Equinor is no exception. with the stock trading at a near 3-year low on relative price to book. So it gives us a number of things. The interesting other angle here is that a lot of the major projects at Equinor are coming into harvest mode, and that means that cash flows coming out of those projects will be very strong over the next several years. So we think pretty well underpinned by this story, starting dividend yield of 4%, and very attractive set of assets across both renewables and conventional.
Yeah, it's an interesting proposition, at $35 oil, where obviously we don't believe oil price can stay at that low forever, given just the capital rationing that is taking place. In an environment where traditional dividend stocks, investors asking questions around the sustainability of dividends in some of the traditional sectors, like financials, like certain parts of retail. I think the positive aspect of the Equinor story is that we believe that dividend is defendable and sustainable, and ultimately, at a $40 oil price, significantly covered. And if to the extent that oil prices get back to $50, we're talking about a company that's trading on close to a 10% free cash flow yield. Look, we're going to shift gears and bring you back into more familiar territory as a technology hardware analyst. Discuss the new energy component of the presentation. Look, what's going on this slide? What's the message we're getting across?
Yeah, look, so the thing we're trying to convey in this slide is really the fact that Europe has a unique set of unique backdrop that could result in a major renovation program that builds on efficiency and decarbonisation over the next decade. We're all aware of the weak economic backdrop, but there's also a political consensus in Europe that these types of investments around efficiency and decarbonisation are good for both the economy and the long-term prospects of the region. So we're just trying to show some of the things that have been announced and contextualized the aggregate of those projects relative to some other major programs that have preceded it. And then I think, from an investment standpoint, it's worth thinking about how you build exposure to these types of themes. And for us, it's really three areas. It's really components, it's systems and software, and then it's delivery and distribution. And if you go on to the next slide, you'll see some of the logos of companies that we have built exposure to across those three enabling industries of what we're talking about.